Time now for the weekly options alert with pro trader Alan Nuckman of Agora Financial. Hello, Alan, and what's at the top of your trader talk?
Hi, Angie. Hope all is well. As you can see, I made it back to the big city, looking for this market to continue to boom. All's not well in crude. I'll get to that in just a minute, but stocks still are solid and setting up for another run.
Alan, your trade in Nugget, which is connected to the gold market, has been a winner recently. What's the update on your WPI trade tracker?
Let's talk about expiration. We had April go off the board, and we also took profits on half our positions for 50% in Nugget last week. Our current positions are in Square and Nugget, which we're in good shape with both. Those are for May, and then the Cisco and the FXY, which is the ETF for the yen, those are for June, so plenty of time for this market momentum to continue.
Alan, your WPI trade trigger this week is pointing at a music stock. Tell us about that trade.
The WPI trade trigger, 10-cent time. TME is the symbol there. Now that's a China play. Now China was up 10% in a month, and it's down 15% in the last year if you look at FXI, which is the ETF that tracks the large cap China stocks, versus this stock, which has been cut in half, and it's down about 40% over the last year. Now the stock setup is great. A great bottom base, trading between 10 and 14 for the last 5 to 6 months. The midpoint on that's 12, so that's the first stop, and then a move up to 14 and beyond. The July play is what we're looking at here. July has 90 days of time because the volatility is cheaper now than it has been because the stock markets have stabilized. Looking at the July $9 call. The low in the stock is $9.22, so we have the right to be long from a lower level than the annual low. So we'll look to see if this stock can take off, and it would be music to our ears.
What are your trading day takeaways, Alan?
Number one, crude crash. It's not what it appears to be. It's just like the farmers that had too much milk, they just dump in their fields because there was no buyers and no storage. Number two, there's some finesse when it comes to trading the futures markets, and that's what we saw. The May contract came to an end, and it's a physically settled commodity. So everybody that stayed in it, which was very, very, very few people, because your broker kicks you out at the contract end, the people that stayed in it were silly and stubborn, and there were very few longs when they needed to unwind. There was nobody there, and that's what caused that problem. But if you look at the June contract, it's stable and trades with a very tight bid offer. So it was just kind of a nuanced finesse move that we saw that was very unique, but it was something to talk about. And number three, back to percentages, not points. Now that the markets have stabilized, we've had this big rally run, up 30% in the NDX, back to the 2800 and the 24K halfway point in the Dow and the S&P. Now that we've seen these big extended moves, it's not as big deal when the prices have big moves because we want to focus on percentages. So yesterday, day before, were 2% moves, and it's a function of the prices coming back. So it's back to more normal, not quite there yet, but I like the way the stocks are setting up for another move to the upside.
Thank you, and have a good one.
Thank you.